Hi, everyone. I hope you can see us. Let us know if you can see and hear us. Good morning. I want to make sure that you can all see and hear us. Good morning. Good morning. Click on the stage button if you have not yet. I'm going to type in the chat box. So you can see and hear. It's great. Thank you. Welcome. I'm Dwania. And my friend here too, well, it's to my right. I don't know what it's going to look like for you, is Danisha. She's the expert. I'm not. I am the founder of Canadian Small Business Women, and I try to do things like these to help educate us, because I know right now we're all looking for ways to diversify our income. And what better way than to try to take advantage of the stock market right now, right? So before you jump into anything, you need to make sure you learn exactly what to do and how to do it. And I'll be learning along with you because I am ready to start trading, okay? So I am going to exit shortly, but before I do, how this is going to work. Danisha is going to do her presentation. You can type questions in the chat box. I will be checking for the questions. However, we will not answer questions until after the first hour or so of the presentation. After the first hour, we'll go to questions, but we'll also go through some scenarios like, all right, I have money, I'm ready to buy stocks. What do I do? And also note that we are not recommending any stock for you to purchase. We are just going to tell you about how to find the ones that might be right for you, how to do comparisons, and all those other things that Danisha will talk about. So enough of me. I'm going to be trying to answer any troubleshooting that might be going on in the chat. I am going to step back and I'm going to hand it over to Danisha.
Thank you. Before I share my screen here, I just wanted to introduce myself. I am Danisha Allen with Edward Jones. I have been in the industry for over 10 years, and I've been a financial advisor where I do stocks and bonds for just over 2 years. And I love it. It's a passion of mine. I help women, men to achieve their financial goals, because when we're going to do investing, we have to have a goal. We're not just going to invest for investing's sake. So let's jump into it. I'm going to share my screen. On this guy. Okay. So you might have seen or heard of the illustration where people were blindfolded and placed in a room with an elephant. And some people touched the legs and thought it was a tree. And there are others who touched the tail and thought it was a rope. They were all wrong because they lacked perspective. They weren't seeing the big picture. And that's what it is with investing. You have to have a big picture mindset. You have to have a financial goal. And today's stocks, we're going to talk about stocks. That's just a minute portion of investing. And you're going to use stocks along with other investments to achieve your overall financial goal. And this is the 5-step process that I use with my clients, and I use it with myself, and I want to share it with you. So when you're going to invest, like I said, have a big picture mindset, have a financial goal. So step 1 is
Sorry, I'm jumping in a little bit because we can't see your screen. I think you need to click one more time to share.
Oh, click one more time to share. I apologize. Let's see. This one? No,
I still can't see. Unclick the little computer thing. Do you see the slash? Undo the slash to share.
Okay, let me just get out of that. I'm going to share. Unclick that slash.
And so it should not be a slash anywhere.
Okay, and this is what I want to share.
Let me see if I see it. Guys, give us a second. It just worked. So yeah. We want to make sure it's going to work for you.
So that one?
I still can't see it.
I want to share that.
Let's see. Is the computer button does it have an X on it or like a slash?
It doesn't
Sorry.
have an X. It doesn't have an X.
Why is it not sharing?
This one.
Give me a second, everyone, because we're not seeing the screen and we want to make sure that you're seeing the presentation itself.
Okay, so let's see that. And then now I want to...
Perfect. So now I'm going to... There we go. I'm going to step out. Bye again.
Thank you. So let's go look at our elephant. And that's the elephant. And like I said, there are people who would touch the legs and, thought it was a tree because they lacked perspective. And with finances or with stocks or any kind of life, anything in life, you need perspective. Alrighty. So I want to say that we start with where we're at now. We look at where we're at. COVID-19 blindsided me, and I am depleted, or I have some savings, and I don't want this to happen to me ever again. Where do I want to be in the future? Say I want to retire in 25 years. That's step 2. So that's where I'd like to be. And then step 3 and step 4 is where you build your strategy. Can I get there? Or how do I get there? And that's where you build, you use stocks, bonds, mutual funds. We'll talk about those things to build a strategy. And then step 5 is where we stay on track. Okay, that's what we're gonna do today. So let's see. So stock basics, that's what we're here for. So stocks, equities, you'll hear stocks referred to as equities or shares. Now, the definition in the Webster Dictionary for equities is a risk interest or ownership of property. Again, it's risk interest or ownership of property. And with stocks or any investment, if you are gonna have the potential to make money, you're gonna take on some risk. So there's a trade-off there. There's risk and there's also reward. Now let's look at the second portion. There's another word that came up that was ownership. Back in the day, Disney, when somebody bought, and I'm going to get to the definition, but I wanted to use that illustration. Disney, back in the day, with other companies as well, when they sold a stock, you would get a certificate, and people would frame it and put it in their kids' bedrooms or give it as a shower gift. And what that piece of paper would mean, you owned a piece of the Disney Kingdom. So you owned a portion of the Mouse, Universal Studios, the rides, a small portion, but you are a co-owner. And that's what a stock is. That's what a share or equity is. It's a piece of ownership in a company. You're now a co-owner of the company. Okay. So we're gonna move on to shares and to stocks and what they are. There are 2 types. There's common stock and preferred stock. Now, the one that you're familiar with is called common stock. And most companies, that's the first type of share or stock that a company would issue. That's a common stock. That's what everybody knows. And some companies may or may not issue preferred shares. Common stock will give you the right to vote. So 1 vote equals 1 share, or 1 share equals 1 vote. You are the ones that will go to the annual meeting, via Skype or sometimes by proxy, and vote on things such as mergers, takeovers, electing the directors of the company. The preferred shareholders don't have that privilege or that right. They are more like bondholders. And we'll talk about bonds later. A preferred shareholder is so called because they take precedence or preference in 2 arenas, in dividend payments, as well as if the company should go bankrupt. So if the company went bankrupt, this is what would happen. You'd pay your creditors, the bondholders, and then the preferred shareholders, and then the common stockholders, right? And then for dividends, and I'll explain what a dividend is, it's when the company has made so much money that after its paid its expenses and retained some for, keeping the company afloat, it would share those profits with its owners, right? So in terms of preferred shareholders, if the directors did not have enough money to pay out dividends, preferred stockholders would get theirs first. And then the common stockholders may not get any at all. They'll get the residue, right? But then you would say, preferred. I would prefer to be a preferred stockholder than a common stockholder. The thing is that the preferred stock price remains the same, and all you will get from that stock is the dividend, and it's usually described as a percentage of the stock price, say 5%. So as long as you hold that stock, you'll only get 5%, and you don't have any other rights or privileges. So let's talk about common stocks that we are familiar with and how we make money. So how we make money, there are two ways that we make money with stocks. It's capital gains and dividends. We just spoke about dividends, but capital gains is the difference between what you paid for a stock and what you'd sell it for. So if I bought a stock for $50 and I sold it for $100, my capital gains would be $50. And that's what is so attractive to people who invest. The capital gains and also that dividend, because that's, every quarter you'll get a check. No matter what the price does, you're getting a check consistently. Oh, no, I wish I could get some feedback, but that's okay. You're tracking with me. Dividend yield. So that's a financial ratio, which just tells me how much dividends does this stock pay in a given year compared to its stock price. So when I want to know, in a percentage form, how much does this company pay in dividends, I look at the dividend ratio. So if it and of course, a high dividend ratio does not mean it's a quality company. I want to say that. We'll talk about that later. But if I were to compare two companies, and one had a 2% dividend and 2% dividend yield, and another had 5% dividend yield, I look at it and say, okay, that was something to keep at the back of my mind, because I want to talk about something else, which is rising dividend. That's where dividend yield comes in. We'll talk about that as well. Okay. So now we're down to strategy. This is what we want, right? We don't just buy stocks. We want to have a strategy. And there are 3 principles that must be applied to be a prudent investor. We're not here to bet and to gamble. We want to be prudent, being deliberate and disciplined in our approach to purchasing stock. So the first one is quality, diversification, and long-term perspective. So we're going to talk about each in its turn. So what is quality? Well, there are people will have different definitions of what quality is, right? What you determine as quality might be different from me. But in general, or with my company and what I believe in my own heart, a quality company is one that has a long track record of performance and growth. And this company would usually share its profits with the shareholders, right? As well as provide price appreciation. So the stock price should be appreciating over time. Of course, it will go up and down, with the market cycle or with the economic cycle, but the trend should be this way, right? Not always, but sometimes these companies will hold a dominant position in their industry. They produce goods and services that you're familiar with, and they usually have a competitive advantage. They usually have a moat around. They're so dominant, and I'm not talking about a monopoly, but they're dominant that they can fight off competition, right? So those are what I would call, those are the characteristics of a quality company. Long track record of growth, performance, steady growth, steady performance, steady price increases, stock price increases, and also rising dividend. And of course, you should be able to be familiar with their goods and services, or can see the value of their product. All right. I know, I should say, why do we focus on quality? Because, historically, companies that are quality companies hold their value over time through market declines. So they usually have ready cash, or their company is so strong that they're able to weather the storm. Right now, in this market, there are some companies that will not make it, but quality ones will wade through the waters and come out on the other side. And even when the stock prices go down, you can, bet on that dividend. So you just wait it out. The stock prices are down, but every quarter you'll be getting a dividend check. So that's why I recommend quality. I'll skip over that. And now we're on to diversification. Now, diversification, the principle is not putting all your eggs in one basket, right? Diversification does not guarantee profits, but it does spread your risk and somehow mitigate against losses, right? I'm looking at a bridge right here, and if a couple of those cables should break loose or be cut, the bridge will still be intact. And that's the thing we want with our stock portfolio. We don't want to have just one egg, and if the egg breaks, it's over for us. We want, if one of those cables should break, our portfolio will still stand. Okay. Now, this is what I do. This is what I do in my office. So I'm sharing that with you. I don't recommend that anyone have, I know we're here to talk about stock, but I don't recommend that we have all a whole, I should say, I don't recommend that we have an all equity or all stock portfolio. We want to diversify across asset classes. So this is an investment pyramid. At the bottom, we have cash, and that's for savings, for your day-to-day, to pay your mortgage, to have a little bit of emergency cash if the car should break. That's, you don't make money there. That's in your little savings account, and you get less than, 1%, point something percent on your money. Income. So those are investments where that will hold, that are stock, that are bonds and GICs. Now, bonds is where you would lend a corporation or a government money, sometimes for a period of 5, 10, even 30 years in terms of bonds. And then every semi-annually, you'll get an interest payment. So semi-annually for 30 years, you'll get interest payments, and it's guaranteed. It's a contractual relationship obligation. Every semi-annually, you'll get a check for 30 years. And then at the end of the 30 years, which is called the maturity date, or 5 years maturity date, you'll get back your principal. GICs are guaranteed interest certificate. This is where you would give the bank your money and they'll freeze it for a year or 2, sometimes 5 years. And then you won't get any income during that time, but you'll get your principal back with a small amount of interest. But the good thing about bonds and GICs and investments of that type is that it's stable, it's guaranteed, it's not going to go anywhere. And that's why it's at the base of your portfolio. And then on the top, there are where you'd put those stocks. And I also wanted to say that you want to have income, which are bonds, and stocks. And I like, in my mind, I view it as a teeter-totter. When the stock market is down, bonds usually rise. So it keeps your portfolio afloat. It's almost like airbags. So you want to have some bonds there. Now, let's talk about stocks, my favorite. So growth and income. In that area, I would put dividend-paying stocks. And the reason why we wouldn't put dividend-paying stocks in income is because stocks have market risk. That income, that dividend, is based on the performance of the stocks, right? So it's not predictable. And then growth stocks are those stocks that don't pay dividend, but they'll give you good capital appreciation or rise in the stock price because they keep their profits. So I'm thinking of a company now that has 1,000 stores in Canada and wants to expand to 1,800 stores in Canada. They're not going to give a dividend. What they're going to do is retain their earnings and grow organically. And that will translate. So they're going to have more profits, more revenue, and that will cause their stocks to be attractive and their stock price to grow. And of course, as you go up that pyramid, and that's why you have less and less at the top, you'll take on more risk. So aggressive, I use those for tactical moves. So if you want to take a little bit of advantage of something that's going on, that has to do with maybe precious metals or other investments called futures and options that are quite risky, and I don't recommend them. That's all I have to say. So aggressive would have to be, it has to be, like I said, like precious metals and taking on more risk. And I would put that to 0 to 5% of your portfolio. Okay. Now, there are other layers of diversification. And with this slide, I'm just going to say that no one stock should take up more than 5% of your portfolio. And you're going to say, but Danisha, I'm just starting out. My one stock will be 100% of my portfolio. Yes, you're going to start like that, but then over time, you're going to diversify. You're going to add more stocks until no one stock takes up more than 5% of your portfolio, right? And I'll reference this slide again. My favorite way of diversification in terms of stocks. So remember, I told you about that pyramid, and that's in general. I don't hold a portfolio that has all stocks. I want to have stocks and I want to have some kind of safety, some kind of bond in it so that my portfolio does not reflect the market. So when we look at the stock market and the market's down by 30%, my portfolio, yes, it will be down, but it will be down by 15, it will be down by half, right? So that's why we diversify, because not all of it is exposed to the market. Now, my favorite way to diversify when it comes on to stocks is this, diversifying by sector or industry, because every sector or industry behaves differently with the in relation to the economic cycle. So the economy will go up like this, and we're at the cusp, and then we go down. So there's a boom, right? And then there's a recession, and it goes on like that. For as long as history has been, that's what happens. And each sector will behave differently at different stages in the economic cycle. Now, offensive stocks, they're closely correlated with the stock market. So financials will be going up when the market's going up, when the economy is going up and all things are going well. And then they will go down with the market. Same with industrials, because when there's employment and there's manufacturing and things are good, but then when there's a turn, people lose their jobs, industrials and manufacturing will go down with the economy. However, on the other side, defensive stocks. So at the top here, you'll see the offensives and the defensives. Now, offensives, these ones, they're more stable. They move with the economy, but not necessarily in a direct manner. Let's look at an example. Healthcare. No matter what happens in the stock, in the economy or in the market cycle, you're gonna always need healthcare. You're gonna need hip replacement. You're gonna need oncology. So it does not spike with the economy, but it doesn't go flat with the economy either. Same thing with communication, right? Even now, in this pandemic, we're communicating more than ever. So those are the stable workhorses. Consumer staples, that has to do with our toilet paper, right? Things that we can't do without. And utilities. We're still going to pay our utility bills no matter what. So these companies are usually large and have high volumes of equity, but there's not much room for it to grow. So they're usually stable like this. And then the offensive ones usually spike and go down. All right, so and you want to build your portfolio so that you have a nice balance, a nice mix of the offensive, because that's where you're going to have that good growth in your portfolio. And then you want to have some defensive that will help you mitigate against losses, or I shouldn't say mitigate against losses, but kind of keep your portfolio afloat. Okay. And there's yet another method, I would say deepening. This is after you have built a good portfolio, after you have diversified across asset classes, and then after you have diversified across sectors, then you'll start to diversify within these sectors by buying large, mid-cap, and small-cap companies. And when we say mid-cap, small cap, and large cap, or whatever I said, it's called, I'm talking about something called market capitalization. And it so market capitalization is the number of shares of a company that has been issued multiplied by its stock price. I remember years ago, maybe 15 years ago, when I first got my first job in Jamaica at the stock exchange. Things have really changed, because as soon as the markets would close, guess who had to calculate market capitalization? It was the new girl, Danisha. So all the stocks on the stock exchange, I had to multiply. If they had 1 million shares, it wasn't difficult, but it was tedious. Multiply 1 million shares by the stock price, the closing stock price for the day. So a large cap company would be one that has $1 billion and higher in market capitalization. Mid cap, $1 billion to $7 billion, and small would be anything less than $1 billion. Okay. Now, let's take a look at an example of diversification. So that blue line would be a tech stock, which is an offensive stock. Remember, we talked about the offensive. So those would perform well when the market is going up, or the economy is going up, and not so well when the economy is going down. So we had one stock. If we had just that tech stock in our portfolio, we would enjoy the upside, but would also really have a sharp decline in our portfolio with that one tech stock. But when we diversify with a consumer staple, you can see that when the tech is going down, the consumer stock price is going up. And that that's reminding me of of now, not necessarily with tech, but with this consumer staple. People were in lines to buy toilet paper, and then people started to buy consumer staple stocks, and those started to rise. Of course, it didn't go all the way up. It didn't peak because the entire economy or the entire market was down. But it compared to its counterpart, it was doing better. So if you had both of those in your portfolio, you'd be better off. You wouldn't experience significant profits, but you'd have spread your risk and mitigated against losses. How are we doing? Okay. So I had mentioned that we're not going to put that as one stock will not make up more than 5% of your portfolio. So say you have behaved and you bought A to F, no more than 5%. So 5% in each. At first, you started off at the level this dotted line here, and you had one stock that was outperforming all the time. That's good news. But over time, you'll find that it will start to make up, 8, 9, 10%, 20% of your portfolio. And then you're going to start to experience unintended risk. Your portfolio will start jumping up and down because it's dragging you up and it will drag you down too. It means it's a little bit more volatile. So what are we going to do? We can do two things. We're certainly not going to get rid of D because it's a good stock. We buy all quality. All of them are good because that's on the premise that we're buying quality. So we can do two things. If you have discretionary income, if you have some money stashed somewhere, you're going to add funds. You're going to buy more of B or buy more of F to bring us back to level. We want a balanced portfolio. I always think of a ship or a boat. And if you have two boats with the same amount of cargo, but then the cargo is on one boat is on one side, lopsided, the one that is streamlined and balanced will go faster. So that's why you'll always hear having a balanced portfolio, right? You want to make sure everything is in balance. So you can add funds. But if you're like most people, you don't have more funds to put into a portfolio. So you can rebalance. And what we do at this time is to take profits. I love to take profits because that means you take capital gains, right? So you bought at the line and you're going to sell at the top line of D. Use my hair. So we bought here and we would sell, not the entire thing, just take the profits, skim some profits, and then you buy low. You buy and put some more funds in B and buy and put some more funds in F because we want to buy low and sell high. And these are quality companies. It's not that there's anything wrong with them. Maybe there was some news in the market, and you know how it is. Sometimes it's not really reality that's going on in the markets. It's just fear and anxiety. And I want to warn against that. That's why we want to have a strategic and disciplined approach. We have our strategy and we hold it to the end, not buying and selling. Because I'll teach you later that buying and selling is not good for your wealth. Now, we're moving quite quickly. So remember I had mentioned rising dividends and rising income and how that would play a part in your portfolio. So inflation, this is where goods and services, the prices of goods and services rise over time. And if inflation, that percentage, the inflation rate stays at its historical level, between 2 to 2.5, we can anticipate that goods and services will double in 25 years, right? So let's say we had a retirement goal, and you said, okay, I like that bond idea. I like that GIC idea where for 30 years, I'm going to get an income stream. Every semi-annually, I will get $1,000 or $5,000 every quarter, let's say, for every semi-annually for the rest of, for the next 30 years. That's all well and good. But what happens when prices are higher, have gone up? And that reminds me of, I don't know if you can think of an older person. Like I'm thinking of my grand aunt now. I'm a pensioner, meaning she had, and she had just one fixed income, and she could not buy things anymore. She couldn't afford things anymore based on her fixed income. And that's what bonds can do to you, because you have fixed income. That's what you agree to. But then as inflation, as prices go up, you can't cover your expenses. And that's why rising dividend makes sense in terms of income. Because if you have stocks that have rising dividend, so this year they pay 2%, and next year they'll pay 2.5%, and the next year they'll pay 3%, and continue on that trend for the next 30 years, you are going to be able to stay afloat. You're going to be able to do the things that you wanted to do in retirement. You can go shopping, and you can go, you can be some of those retirees that go traveling the world, because of that rising dividend. So that's where that plays a role. And you want, when you're thinking of stocks, so put things away in, note things. Think about rising dividend. When you're doing your research that I'll show you, look for companies that are expected to rise dividends at an above average rate. So we're looking for rising dividend above average, so that you will stay afloat of inflation. And that's on the income side. The stock prices will speak for themselves. The stock prices will go up over time, right? And I don't want you to just chase dividend. So remember that rising dividend yield. Don't look for stocks that just has high dividends, because if you have high dividends now, you may not be able to continue it in the future. So don't snub companies that have a low dividend but are expected to rise over time, right? So I'm not saying chase dividend yields, but look for dividends that are expected to rise over time. Okay. Now, so on the third principle, long-term perspective. So we looked at quality. We looked at diversification. So the strategy is to buy quality, hold them in the right proportion, remember diversification, and then hold them for the long term. So quality, right proportion, right? So that some will go up, some will go down, and mitigate against losses and hold it for the long term. That's called a buy and hold strategy, not a buy and forget. Remember our 5-step process. We're not going to buy and hold and buy and forget, but we're going to buy, hold, and watch. We're going to be vigilant. So you might have seen or heard of people who buy and sell all the time. And some people say, I'm on the sidelines now, but I'm going to buy later because when the market's hot, I'm going to buy. But people who do that, they call that the timing the market strategy. They'll find that they're too late when they're trying to time the market. When I'm thinking of timing the market, I'm thinking of somebody doing a skipping rope, and they're timing the rope to get in. And sometimes it's too late. It's difficult. And I'm gonna show you an illustration that timing the market doesn't work. Oh, and I should mention Warren Buffett. He is my favorite. I like him because he's full of wisdom. And somebody recently asked him, I don't know if it was recently, but I came across it. Somebody asked him, why is it that there are so many people in the stock market that are not rich, right? You know, the stock market is supposed to make you rich. And he said something very wise. He said, because nobody wants to get rich slowly. Right? Think about that. There are millions of investors and very few who are, I shouldn't say, there are more people who are broke and more people who have said they have lost everything than those who are doing well. Okay. So let's look at an example. So this is a hypothetical example of $10,000 being invested in the S&P 500 or the TSX, which is the stock market in Toronto, the Canadian stock exchange. There are multiple stock markets, and we can talk about that later. But this is the Canadian one. And say you invested $10,000 for real, but play in 2000 and this slide, the principle is the same. You invested in 1977 and until 2016. It's the same. Even my paper says from 1998 to 2019, but the period is the same. If you missed the 5 best days, so if you had invested and bought and hold your investments that entire time, you would have, from $10,000, you'd have had $390,000. So 9.8% annually. The reason why it's 390,000 is because it's compounded 9.8 each year on average. And that's why you're up to 390. But missing the 5 best days, if you sold at all in that time and missed the 5 best days, you can see what happens. If you miss the 50 best days out of that whole time period, you would have only had 45,000. Now, who wants to pick the 10 best days? Who wants to pick the 5 best days in the next 30 years? Even if you had some kind of powers, some kind of prophetic powers, I don't think it's quite difficult. So it makes sense to buy quality, diversify. Buy quality, things that you can hold on to, diversify, put them in the right order, and hold them for the long term to maximize your returns. So this shows that time in the market is better than timing the market, buying and selling. It's not good for your wealth, just like smoking. It's not good for your health. Trading is not constant trading. We're not saying buy and forget. We're saying hold it for the long term, evaluate, and sell if necessary. And you have to have a good case to sell it. Okay. And that brings me back, of course, to that 5-step process where, you have your goal and you keep on track and you tweak if necessary. So we need a systematic approach. And that, that 5-step process is good from a big picture perspective. But the best way to have a disciplined approach is what I call, or which is known as systematic investing. And I do it. My husband does it. People who are starting out do it, and people who are established do it. And systematic investing is really investing in small amounts at regular intervals. So I invest every week, every Friday. My husband invests. It comes out automatically. Something that you won't feel, right? A small amount. If it's $50, it's $50. So I invest both with systematic, and if I have a lump sum at any point, I come across some cash, then I will put a lump sum in. But every Friday, I put $50. I invest $50 every Friday for the month. My husband does the same. So it doesn't have to be a large amount. But what that does, it does not guarantee profits, and it doesn't mitigate against losses. But what it does is this. It makes you buy more shares when the prices are down, the stock prices are down, and less shares when the prices are high. And therefore, it gives you a lower average cost per share than somebody who dumped $100,000 in stocks. And I'll show it to you. So here's an example, hypothetical example. Somebody in January invested $5,000 at $20 per share, and they got $250 shares. And then there's somebody else who bought 21 shares, say at $19 or at $20, and then 26. I'll show you 26 when the price was low, then 28, then 35 at about 12, and then it goes. So you get to buy more when the prices are lower, and then of course less as the price goes up. And at the end of the same time period, you would end up with more shares, 300 shares, than the person who invested 5,000, because you were consistent. And the average price per share was $17. We always say buy low and sell high. So over time, that will help with the performance of your portfolio, because you bought on average at a lower price. And then when you get to sell, when the markets are up, then you will be at an advantage. So that's why. Okay. Now, let's look at ways to buy stock. Of course, you can buy them individually on any exchange or any platform, but there are other methods, other ways to own stock. So some of you might have heard of mutual funds. Now, mutual funds, so mutual is where everybody pool their money together, and there's a portfolio manager. Not me, that's a portfolio manager. I buy mutual funds. I'm not a portfolio manager. They're really smart. So they pool the funds together, and then this way you are able to, and the fund manager buys a basket of stocks, and they are the ones who will do the diversification, and they will study the market, and they will have it down to a science of how to put the stocks in such a proportion that when one goes up, the other goes down, and you're smooth sailing. I think of mutual funds. I always try to think of, my mind works in pictures, of an elevator. Which elevator would you want to go up? If you're going up the CN Tower and there are two elevators, one has one cable and another has 300 cables. Which one would you go up, at least at first? The answer is clear, the one with 300. So mutual funds is a basket of stocks, and sometimes they have bonds, so they are balanced funds as well, and fully diversified. And the good thing about it is that you can buy it for a small amount of capital. A small amount of capital. So just to kind of delve into how I started out at first. So I and my husband as well. And then I did mutual funds first, and then I took some profits, and then I bought stocks, and then I bought more stocks, and then I moved on that way as well. I bought that $50. I used it to buy. So sometimes it would be 100. So the trade would go through twice a month, and maybe it would be $100 into a mutual fund each month. And that means, so then I could buy 5 units or 10 units or 100 units of a mutual fund, a balanced portfolio. You buy a portfolio and grow your wealth that way. Now also, I'm sharing now. Also, I buy stocks in that way as well. So I use $100, and my husband as well. I buy stocks $100 each month. So there's one portion that goes to mutual funds and one portion that goes to stocks. So you buy stocks small amounts over time. When the stock prices are down, I get more units, and when the stock prices are up, I get less. And we can talk about that a little bit later in the question and answer, because I am not. You're looking at someone who wasn't born in the lap of luxury, and I came as an immigrant, so I didn't start big. You don't born big, and we should not despise small beginnings. So if you're just getting started, you can do it too, and just give yourself time. If your goal is to become a millionaire, you will get there. Just give you some time, right? That was a spiel. Do we have time? So we're at the end, so I can talk a little bit. So mutual funds. So that's what mutual funds are, and then ETFs. That's a basket of stocks as well, and it has a portfolio manager. But this portfolio manager will buy almost all the stocks on the stock market to mimic the stock market. So it will go up with the market and go down with the market. There's not that much. Yes, you would say diversification. There's diversification, but it mimics the market. So whatever the market's doing, you're doing it as well. So that's ETFs. ETFs trade on the stock exchange like a stock. They're units of the entire stock market. Well, I don't know if you understood that, but we'll talk about, we'll discuss it. We'll flesh that out later. Passive and active. I touched on it a little bit. So so we're talking about the mutual funds and ETFs. They're managed by portfolio managers. Most mutual funds are managed by an active mutual fund manager, and ETFs are usually passive. Active are those who try to outperform the stock market. They will do research and buy stocks in such a way. They don't buy all the stock market. They'll buy some and put them in such a way that they'll try to spread or prevent the mutual fund from participating in all the downside. They don't want to look completely like the market. They want to mitigate against losses. Active funds usually have a little bit higher fees, and it's because of that research and that management expense is a little bit higher, where on the passive side, the fees are lower because there's less decisions. For passive as well, it's a little bit more tax efficient because they're not trading at all. I'm not saying trading isn't. There are times when trading is necessary, and we don't trade every single day, but there are times when you might need to take out something out of your portfolio. So that's what the active portfolio managers will do. And so there's some trading in the active side as well. I hope that makes sense. We'll talk about it after if you have any questions. So there is a trade-off. Active fund managers may not actually outperform the market. They'll try. Sometimes they're successful, sometimes they are not. And even passive fund managers, sometimes they will underperform the market. Even though they try to mimic the stock market, they sometimes underperform the market because of the fees. So I think that is that with active and passive. We're talking about mutual funds and ETFs. So let's recap. We're at the top of the hour. We talked about stock basics. We know what a stock is. It's a piece of ownership in a company. We know what dividends are. There are payments of profits to the company. We know what capital gain is. Where the stock price, we buy at a low price and we sell at a higher price. That difference, that profit is capital gain. And we looked at the three principles of investing: quality, diversification, and long-term perspective. And that's all I have for you today. I'll turn it over to Miss Dwania. Here we go. Now we're trying to, so I'll stop sharing.
You want to stop sharing your screen, and then everyone can see both of us. Some questions and some scenarios. I took 2 pages worth of notes.
Are you kidding me? Wow.
2 pages. Okay, so everyone can see us both. I wanted to first thank you because I feel like I learned a lot so far, and I'm getting ready to really dive into this stock stuff. I wanted to go through just to make sure we understand all of these little definitions that I keep seeing wandering around. Everyone, if you have questions, feel free to type them in the chat box and we'll go through them, because I know I have a bunch of questions that I'm going to ask. So I'm just trying to fix my screen a little so that I can see what's going on, and I have like a little cheat sheet. Okay, we talked about what a share was. Can you explain to everyone what an IPO is?
So an IPO is called initial public offering. So when a company goes onto the stock market for the very first time, that's their IPO. I can think of Facebook when they first came on. It was a big deal. And so that's when the company actually gets the capital. So why do we even bother with shares and stocks? Is where companies issue shares and stocks is because they want capital to expand their business. And it's in that IPO that they get all those millions to expand their business. What you see now, trading of Facebook or whatever, that's in the secondary market that we are familiar with, and they don't get money from that. The companies don't get money from that. It's just you and I trading shares, making money that way, buying and selling.
So do you advise that when companies, like when you see this whole thing in the New York Stock Exchange and they get to ring the bell and now everything's open for public offering, do you advise people to dive in at that point? Especially if for some companies, the history, because I remember you said quality and that equates to knowing the history. Yeah. For some companies, you don't know that much about them.
Yeah. So yeah, when something just comes out, it's quite a gamble. So my perspective, I'm for the long-term conservative, prudent investor. That's who Warren Buffett is. We, of course, you can look at their the prospectus of the company, and you will have to decide if this company will have a future. But I would recommend sticking with companies that have had a long track record of performance and growth, and hold it for the long term. Because there are many who remembers the dot-com bust. No, nobody too young for that. People are too young for that. But in 2000, early 2019, when the internet just came on, many of those companies are gone and they had IPOs. So, yeah.
Okay, so research. Only invest in companies that you can have some kind of
confidence in.
Yes. And I guess the same goes, a lot of people talk about penny stocks. Explain that to people.
So penny stocks are companies that are anything below $4. People, you get what you pay for. If you say penny, they don't even make pennies anymore.
True.
Right? So, of course, I can't make any recommendations, but I don't recommend buying penny stocks because they do not have the potential for going any further. Their valuation, that's what they're valued. Right? And when we're buying, I don't want to preempt you whatever question, but when you're buying, okay, I'll leave that. So I don't recommend buying penny stocks. All right. We want to buy quality
stocks. I see some questions here. When you say, let me try to scroll up. The first one, based on the diversification pyramid that you've shown, what would your recommendation be for allocation?
Mm-hmm. So there are, I know that question would come up. It's a little bit more involved. So what I do, and maybe it's on the internet, there are 6 questions, and it's at my workplace. But I will try to diagnose what your risk tolerance is. Your risk tolerance, because people want to make money, but they don't know, their gut cannot take it. So I'll ask them questions such as, I'm trying to remember what some of these questions were. What is in terms of your objective for your portfolio? Do you want your portfolio to outperform inflation or not? Some people, if your objective, what's your objective? Do you want to have income, just steady income, to preserve your income, or you want it to grow? I'll ask those questions, and it'll give me a score. And then based on their score and their stage in life, I will determine what portfolio to build for them. So let's say, for example, Dwania looks like a young lady, young person. And I looked at her, I know, and she's young and she wants to retire in 30 years. Even without the risk tolerance, I would build her a growth portfolio. That would mean 80% of her portfolio should be in stocks and 20% in bonds, because we want it to grow. I'm not going to give her a complete equity portfolio or a stock portfolio with all stocks. She's going to have a little bit of safety to bounce off of, so she doesn't look, when the stock market goes up and down, she has something to bounce off. I'm going to give Dwania a growth portfolio. If her objective, if she wanted to hit her goal earlier, if her goal was in 5 to 10 years, I would give her a balanced portfolio or a balance towards growth. Maybe give her 60% equity, 60% stocks, and 40% bonds. Because we, at that time, as close, when your objective is closer, we want to preserve. So we're going to put some bonds, 60% in equity and 40% in bonds. And even closer then, or if based on your risk tolerance, because I'm trying to give you the think about in your head and write it down. 80% for a growth portfolio, 80% stocks, 20% bonds. Balance towards growth. So I want some growth, but I want it to be balanced. I'm gonna put 60% in bonds, 60% in equity and 40% in bonds. Closer, when you want 50-50, balance growth and income, we balance it 50% bonds, 50% equity. For older guys, for older folks, when they're approaching retirement, I flip it, because now there's no chance to recover from any market downturns, right? So as you get older, I would flip it. I would put, even when you get actually older, 60% in bonds and 40% in equity. I hope that makes sense. No?
Okay.
No?
I think so. I think it does. Yes. So the other question, when you say no one stock or investment should hold more than 5% of your portfolio, does this rule apply for index funds? First, what are index funds?
So we were talking about that a little bit with mutual funds and ETFs. So those are baskets of stocks, right? So my rule is for mutual funds, I don't have more than 25% of my whole portfolio when I'm building a portfolio at all. So I'm looking at my platform. If I'm going to put some money in a mutual fund, I'm not going to put more than 25% of the person's whole portfolio in any one mutual fund, 25%, right? And then for stocks, when I'm buying stocks, 5%.
Got it.
Of the entire portfolio. So sometimes, based on the portfolio, sometimes it's $5,000. That's a sweet spot at first, and then you.
Okay. It says, do you invest in index funds? What's the advantage and disadvantage?
So index funds, maybe she's talking about, so index funds, you're talking about ETFs, exchange traded funds, and those mutual funds. They have their place, but the only thing is that, and I use index funds that kind of cheat, meaning that they don't, because I don't want to have a fund that mimics the market all the way, because that's not what we want to, we don't want to be completely exposed to the market. We want to take on all the market risk. So I'm thinking of a fund now that that's the only ETF that I kind of use. ETFs have their place, but I'm saying, I use mutual funds that have a little bit of activity in it. I don't want it to just completely mimic the market. And I want an ETF that somebody thought about and really put this, didn't just went and bought everything, because not everything on the stock market is good. So I do use exchange traded funds, but it has a little bit of cheating, a little bit of thought into it. And so I don't want the ETF to completely mimic the market and participate in the downside. Because right now, so the economy goes up and down, the market goes up and down. People who have ETFs right now and did not diversify in any other way, they are crying because they are restricting the market. Done.
Do you recommend reinvesting your dividends?
Yes.
Definitely.
Yeah. With cash, we don't want the cash. We want it to. We invest it even in the same company. So there's also a method. I don't know if it's on your platform, but you should be able. Any platform that you're going to invest in should be able to opt into reinvesting those dividends.
Okay. This one says, what can we use to do research on companies to learn about their yields? I know you love this question.
I know, because I knew it was coming. All right. Shh, guys. So I'm not supposed to make any recommendations because of my license. Anything that I say is almost like a doctor. Dwania, do you have any?
I have some recommendations. So there are a couple of things that you can use. There are free tools and then there are paid tools. You can use Morningstar, which is a paid tool, but it is like amazing. So I can type that in the chat box. And Yahoo Finance is a free tool that you can use to start researching some of the stocks. And it does give you some live market activity. So those are the ones that I know I will be using, Morningstar and Yahoo Finance. Those are the only two that I know of. And, we want to make sure that Danisha's license is preserved, so she cannot make those kinds of recommendations. What is the best way to get started if you're completely new? So this is kind of where the scenarios come in. First, before Danisha jumps in, you need to pick a platform of where you're going to do your trades. Personally speaking, I use Scotia iTrade. That's only because I like them. And the great thing about most of these platforms, I know I can speak for Scotia iTrade, is that when you sign up, they give you the option of you have your regular cash account for trading, but you can also get a practice account. And the practice account, they give you, I think it's $100,000 Canadian and $100,000 US. This is not real money. It's play money, guys. And you can practice using that account, trading, watching stocks, all that stuff, so that you can, one, get a feel of the platform, and two, get a feel of how you'd be spending your own money before you dive into working with your own money. So here are a few platforms that you can try out. Don't try out. You can go and research and compare them. So Scotia iTrade, E-Trade, of course, Quest Trade, Q Trade, Wealth Simple Trade, or you can just check your bank, because most banks have trading platforms that you can go in and, you know, play around with. I'm going to type all this in the chat, but I'm going to stop talking so that Danisha can start giving you some scenarios. Like, I have some money, what do I do?
Okay. So say I had money, say $10,000, maybe not, right? I'm just using a round figure. I'm going to look for what's on sale. We are ladies here. We know what sales are. So I am going on to, what did you say? Which one did you recommend?
Morningstar.
Say Morningstar, for example. I'm going to go on to Morningstar, and I'm going to look for a company. So, okay, first, I'm going to look for 5. You're not going to start out with 5, but in your head, we're going to talk about those industries. Remember, we're going to look for a financial, a communication, healthcare. We're going to take 5. Right? And then, so, okay, I'm going to pick, let's look for healthcare. I'm going to go onto this Morningstar here. I don't know if you have to pay for it or it's free, but you'll go on it and it's going to say market price and fair market price, fair market value. So that is what, based on the research and all the ratios and the projected earnings of the company, this is the price that it is worth. The value of it is. That's what it is. So, so all its future earnings, they have given it a value of, say, $40 per share. I'm going to look at what it's trading for now. And I look and I see it's trading for $25. I'm going to buy that because it's real value. It's just like something is on sale, like a swing set for my son. It was $300 and there was the last one and I got it for $50. Nothing is wrong with it. Nothing is wrong with the swing set. Nothing is wrong with the stock. The research is telling me it's worth $40, and here it is. It's at $50. It's not $30, $25. I'm going to buy that because it has room to grow. What we're not going to do is buy a stock which is worth $40, and because of hype and because of news in the market, buy it for $45. No bueno. So that's what we're gonna do. And also, some of these research platforms will give it stars. So anywhere between 3 and 4 stars. Very rare I see 5. 4 is like, yes, buy it for sure. 3, I shouldn't say all of them, but 3, 4 star. Also, when we look at the research, it's not old school. All of this thing is on the internet. Because I remember back in the day, I had to be doing financial ratios and madness. No, we don't do that. So we go on that same platform, that same website, and look for rising dividends. Remember, we talk about rising dividends. It is projected to rise over time. If it says stable, maybe you can buy it. But if it says like it doesn't, if it says that it is not expected to rise, I don't know. No. That doesn't mean though we don't buy stocks that don't give dividend. Because it means the company is retaining its earnings to grow. And that's where it takes on a little bit more risk, but you really get some price appreciation. And that's what we're in the business for. Price appreciation, capital gains. So that doesn't mean if it doesn't have dividends now, or if it have low dividends, don't snub your nose. Because just like, don't laugh at me now, give me some time. Right? Okay.
All right. So Nora, I hope that kind of helped you with your question too. Rihanna is asking, what do you think of new app platforms where you can buy stocks or shares individually? She's talking about places like Stash and Stockpile.
I don't have an opinion on those. I don't know. I really don't know. I would also, well, my sister, actually my little daughter, she just got married, but she thinks she's so grown. So she's buying stocks and things, and she would come to me. And she tells me, so, I can trade for free. And I said, that's something else. And then she said, but there's something called a margin account. And I said, girl, stop right there. So if you see something where it said margin, stay away. That is for big companies that can hold it. It's really they're lending you the money. So they're lending you the money to buy. But what happens is that, and that's what you'll see in the stock market, what happens as soon as the stock price falls below a certain threshold, the computer will automatically sell and take their money back. So stay away from margin. So where you say you can trade for free, there's nothing called get rich quick, and there's nothing called free. You know, when you talk about free, just like that. Yeah, just be aware of those things. Some of these apps, just tried and true regular stuff. Stay in the middle of the road.
You recommend to diversify by industry and company size. Once you do this, is there a third way to diversify even further?
I wouldn't, there's no other method. I guess there may be, but after you do across asset classes, you buy your bond funds. I would recommend buying bond funds, buy bonds, buy stocks. Then making sure that your stocks is in no more than 5%. Then you invest by industry. What else is there other than to go deep? So you're within that industry, you go deep by buying large. So this is one industry, and I'm gonna buy large cap, small cap. So there's also another thing you can diversify by, and this is very important, good question, by territory. So we don't want all and I should have spoken about this, good question. We don't want to buy all Canadian stocks. We don't want to buy all US stocks. We want to buy stocks from all over. But if you're just getting started, I would stay US and Canada. And then, then after time, you can maybe branch out into emerging markets. That's at the top of the pyramid.
So if you're looking into diving into stocks on markets from other countries, what kind of research can you do on those countries before you?
Yeah, so it's not really countries, so those platforms, those research platforms, you can search them up. Mm-hmm. They're on there. Well, I should say not every research company will follow every single stock, because sometimes it's not worth it to even invest, to even pay real analysts to look at those companies.
Okay. How many times per month, or like when it comes to trading fees, how many times do you feel people should be making trades per se?
Okay. So when you say making trades, like buying and selling, mm-hmm. No, we buy. Right? So
no selling. No selling just yet. But how often should you buy? Like, are you going in every day searching for stocks to buy every day? Or are you watching and then maybe once a month you try to just buy what you've seen from your watch list?
Yeah. So I was telling you how I invest every week. Well, a trade might go through twice, but I save systematically into mutual funds. And then at my company, I can invest a minimum of $100 into a stock without excessive fees. So it doesn't make sense. So there's two things. The sweet spot, at least at my company, I would say, if you're just going to buy in a lump sum, the sweet spot to buy a stock is between $4,000 and $5,000 to make it worthwhile, because the trading fees is 2 0.5. And that's the same thing. Yes. And on the platform, those platform is the same. It's not free. So we're not gonna, so then if you buy $100, if you buy say $1,000 and the fee is it's gonna be sometimes it's a minimum of $100 or 2.5. Anything less than 4,000, you're gonna be paying more in proportion. You're gonna be paying more in fees as opposed to investing. So we don't want to be paying fees for paying fees sake. So if you're gonna buy one time, buy like a 4,000, 5,000, and then that where it really works out. Or you can buy small amounts in like $100, and it's 2%. It's actually 2%, and that's what I do because sometimes I don't have a bunch of money
to be trading and paying,
instead
of
making because my mentality is systematic investing. Whether I know it or not, whether I feel it or not, I'm investing. When the markets are down in March, right, I invested because everything was on sale. It's perspective, guys. There were people who were just selling and going crazy when all of these good companies were on sale. It's like Boxing Day. Yeah.
I heard, I'm not recommending this, just throwing that out there, but I know I have a friend who she was on top of like the huge theme parks because right now they're like going down. Like when you think of like the Six Flags and the Disneys and stuff like that, like yeah. So, think about all those giants that you've always wanted to invest in. Now is the time to start looking because you know that they're going to bounce back.
There you go.
You know the value of their stock because you have researched it. What is the value of having different dollar accounts? So let's say a Canadian dollar account, US dollar account, and if you're trying to invest in other countries, the dollar account for them as opposed to just having one account and trading based on that.
Right. So some people will have two accounts, a US account and a Canadian account, because companies will charge, your platform will charge you to exchange, right? So that's why people might want to have two different ones. But on average, I would say if you have a Canadian account and you buy US, because I don't have a US account, but I have US stocks, over time, I'm going to hold it over time, it's going to come out in the wash, right? Yeah.
Got it. Okay. Suggested share amount, like if you can afford one share, you buy one. Like how do you buy them in groups? How do you do that?
So it's your dollar amount, what you've got. So say is what you've got, right? But again, I was telling you the sweet spot, if you're gonna buy a bunch, if you're for the fees to work out for you, right? It's 4 to 5. And that's why I did mutual funds first, grew it up, and bought my first stock, and then went like that. And I also do that systematic investing where I do sometimes if it's $100, sometimes you can't even buy part of a stock because of that systematic investing thing. But you don't just go out and say, I'm buying one stock, sir. That doesn't work.
Someone says, what is diluted earnings per share?
Diluted earnings per share.
It says, what is diluted? Naomi, do you want to expand on your question a bit so that we can make sure we understand it? In the meantime, how often do you review your entire portfolio? Like, is it possible to make changes, adjust ratios, etc.?
Yes. So I recommend, and it's your account, you look at it all the time. But when I'm meeting with clients, I meet semi-annual, mandatory once a year, but I meet with clients twice a year, right? So that they can see what's going on. Yeah. If you look at it every single day, it will drive you berserk. unless it's your job to look at it every day and you're not emotional. But annually.
And if we're all going to try to play and trade, it's nice to take a look at it personally, I'm going to look at mine probably once a week. And then when things, depending on how things are looking out there in the world, I might be on it every day.
Yes, but don't be on it to sell every day, because there is also a fee to sell, right? Yes. So it's costing. We're in saving, we're investing, we're not into spending. Mm-hmm. And I'm not saying that, I'm not saying that we're looking for cheap, because there's value in, if you're gonna get, management, you're gonna get additional services. If you're gonna do it on your own, then you're not into this buying and selling and spending.
Yeah. So if you're doing it on your own, you're trying to just buy and watch. If you're looking for help, because I know for me, I want to toy around with it on my own first, because I can do that. And then when I want to start rolling with the big dogs, I can try to get some more help, because I'm going to get there, right? Now is the time to start looking. So start seeing what you can do. And you're home.
Yeah, right. I don't want you to say rolling with the big dogs, because I'm not a big dog. I started with my own self, and I have
big dogs with knowledge.
Okay.
Not funds.
Okay.
Because now because it's kind of like you have to have an idea of what that professional is going to do for you.
Okay.
You have to have an understanding, and this way you go in more educated, and it makes it a lot easier.
Yes.
I'm sure it makes it a lot easier for you with clients.
Yes.
When they have an idea of what you're talking about.
Yeah. That's good.
Okay. I feel like I'm sweating, guys. Whew.
Okay.
I'm learning so much. I'm trying to look through my notes.
Earnings per share is the profits of the company divided by its share price.
Okay.
But I don't know what you said, diluting it. It might sound. And look, if I don't know the answer, I can look for it for you and tell it and give it to you. I'm not.
Oh, she said she sees diluted earnings per share as part of the stock indicators often, but she doesn't understand what it means.
It's just the earnings per share. And I will also look for it as well. I'm the first person to tell you, if I don't know the answer, I'll find it for you. Right?
Okay. Janelle saw definition. It's a calculation used to gauge the quality of a company's earnings per share if all convertible securities were exercised.
So it's the earnings of the company, right? The profit, the profits divided by by per share. It's a financial ratio.
Okay. Can you tell us what services you offer and where everyone can find you and more info to hire you?
So I work for Edward Jones, and I own my own book of business. So I do financial plans and advising for free. I'll tell you the services. So I do financial plans, the same thing, and it's for free. And then with investing, so it's the investing portion that will cost. So my services don't cost, right? So for mutual funds, I don't charge any commission on it, because within a mutual fund, there is something called an MER. Write it down, children. Not children. No. Yeah. An MER, which is called a management expense ratio. And the management expense ratio is where you remember that fund manager? Yes. And it's usually between 1 to maybe 2.5% of the fund that comes off every year, once a year, right? That's what the management expense charge. So if the fund performed 10% and they do, it really did 12%. So it comes off before you even. So that's why I said they talk about hidden fees. I'm here to tell you where those hidden fees are. So management expenses, when the fund performs at 5%, 10%, it really did higher, but they take that percent off. And then the company, it doesn't matter, they're all the same. So I don't have any prejudice. They will give my company maybe 0.5%, and then I get a percentage of that. That's how I make money on mutual funds. And it's not a lot. I should really do commission, but it's not. I don't think it's good. Because if I'm gonna get money, residual income from it over the years, then I think it's worth it. Stocks, it's 2.5% on stocks. And of that 2.5%, I get 40%. And so that's why I tell people don't buy just stocks here and there. It's spending money. I make money on my own. And how I make money is when people invest large amounts. So I'll tell you, so I'm letting you know how I get paid. So that's why commission and that kind of thing doesn't entice me. It's when people come and give me like $1 million. I shouldn't say $1 million, but like I have an asset bonus. So when somebody invests money, I get $4 for every 1,000 that is invested. So I'm not here to gorge your eyes out. I'm tell you how I get paid. Financial advice is free. Financial plans are free. It's and at my company also, there's an individual account that is free. And I always say, start up with an individual account. And when your money gets up to say 5,000, then you move to a tax-free savings account, which is $56.50 each year. A year. There's an admin fee for that. That doesn't come to me. It's just to report to the company, report to the government that this person is going to be making capital gains, and it's really high. Do not charge taxes. Don't tax her. So that's the fee, $56.50 for telling the government don't charge taxes. So that's my thing. Advice, financial plans are free, and investing 2.5% to buy stocks. And I don't charge commission on mutual funds because I'll get paid from them anyhow.
Perfect. And you can actually, if you go to the people tab and click on Danisha's name.
Okay.
Then you can see where you can contact her. It has her LinkedIn profile right there. So you just click on it and then you can connect with her. I will also, Danisha, if you want to type in the chat box, like your email address if people want to contact you.
So I'm backstage. Does that mean I can still type?
You click on the event one because you have, I think, backstage and then click events.
Oh, no wonder I couldn't see all of these things. Okay.
Okay.
That's okay.
And you just type your email address so everyone can know where to find her. So everyone also, I started a private Facebook group where we can all join and we can talk about what we've learned and see how we can, help each other. I'm going to click the link. I'm going to put the link in. Just give me a second.
What's my work email? My work 728. So if you have any questions, if you want me to, build a financial plan for you, I'll do it for you. Don't let, and you can do it on your own if you want. Don't let anything blindside you again. Decide that this COVID-19 will be the last of my financial woes, Yeah. And you don't have to be an expert. You don't have to be rich. You don't have to be anything. You just have to apply strategy. Because my husband is a personal trainer, and his business, he can't work right now, but his own. Because I tell you that my husband invests as well. He has money sitting on, and it's not because he has sugar mama.
Someone says, is there a minimum amount of money you need to start?
No.
Just dive in.
Just dive.
What's the difference between using a TFSA account versus individual account to invest?
Yeah.
Or advantages or disadvantages?
Yes, girl. So I love a tax-free savings account. I have it. And that's the reason why my husband is not joined with me, because each person has to be on their own. One SIN number for tax-free. It's a government account, which is encouraging everybody to invest. And what happens is that all your capital gains, all your dividends, tax-free, right? And that's we're in the money of making money. In the business of making money. An individual account is free, but if you were to sell from that account after you buy your stocks, and I'm going to tell you, stock will make you money. But I try to be prudent. I want people to know that there are benefits, but there are also downsides. So you can make a lot of money using stocks. When you're going to sell, you are going to incur taxes. Yeah. There's two things that are certain, death and taxes. So that's what in the individual account, you're going to incur taxes. But when in the early days, unless you become a millionaire overnight, but by the time you get to 5,000, I would say move to a tax-free savings account. And then you will have to pay $56.50 a year. Most of you paying $14 or $15 a month to the bank. So the difference between a tax-free and an RSP. Tax-free is after tax dollars, because I say you have to pay taxes somehow, right? But going into the tax-free savings account, you already pay taxes from your paycheck or from your business. So this money was after tax dollars. So when now you're going to make your money grow for you, you don't pay any taxes. RSP now is, it reduces the taxes that you pay now. We're almost there. Look at this. It reduces the amount of taxes you pay now, but later when in retirement, you pay it. So there's a fine balance that you have to thread, because I have clients now who all they dump money in their RSPs, and now that they're in retirement, they're paying more taxes in retirement than and that should not be the case. So, yeah.
Okay. Any more questions, everyone? We still have about 15 minutes. If you have any more questions, I need to look to see if I covered, I had some more things here. Real-time stock quotes versus delayed stock quotes. Any insights? Because I think Yahoo Finance does real-time stock quotes.
Yeah, and it just depends. It's all the same. It might be a little delayed, but it's all the same. It's not. I don't think it will affect your if you see it delayed or not. Yeah.
What are considered over-the-counter stocks?
So over-the-counter is when I made a list of that one, because it's because I'll give you it's for companies that don't meet the requirement to get on the stock exchange, because there are hoops you have to overcome to get into the stock market. So if you don't meet the requirements, if there's low investor interest, if there is low volume of trade, if the company doesn't want the costs associated with listing, and if the company is unwilling to abide by exchange rules, then you do over the counter, and because you're still entitled to trade. So it's the term over the counter came from when back in the day, really, we would buy stocks over the counter of a bank. At a bank, a teller would, and you get a piece of paper and exchange it. So that's the over-the-counter market.
So in your opinion, would that fit in the lack of quality bag?
I would say.
Okay.
Don't bother with that.
Got it. Noted. People noted.
Yeah, because if you can't meet the requirements of the stock exchange, if there's low investor interest and low volume, that tells me something. If you don't want to do the rules, follow the rules.
Good. All right. Any more questions, everyone? I want to make sure. Let me see
Can you read that?
Oh yeah, where does e-currency fit into buying and trading?
I don't have an opinion on e-currency. You're talking about like Bitcoin?
Is that what you're talking about, Rihanna? Are you talking about Bitcoin and things like that? Let us know. In the meantime, Anna says, I have money in a TFSA, but since COVID and the downturn in stock, I haven't bought any stocks, too uncertain. Where do I start in this environment? Well, you just learned the tools now, Anna.
Yeah. So you can go to, what was that place? Morningstar. And you can start by looking. Remember those 5, look at the 5 industries. Just think about it. You still need, and these are things that you're going to need in your own life. You're going to need communication. So that's one. Communication. You still pay your bill. There's utilities. You may use utilities, may not. Healthcare, right? Financial, so like a bank or something like that. Yeah. Transportation. So they're different. Let me take a snapshot. I'll take a snapshot of that. That's of those. You remember that slide of the offensive and the defensive? You want me to show?
If you can email me a snapshot of that slide, what I'll do, everyone, I'll put that snapshot in the Facebook group.
Yeah.
So that you can see where to go.
Yeah. And then you go on and you do your research. And when your research will look, you don't have to be an expert, not even the ratios as much, but you can, there is a whole blurb, like a 2-page document of what the company is without looking at the ratios, right? And you can look at what the fair market value, what it really is worth, and what the actual price is. And we want to buy below
the fair market
undervalue, so it has room to grow. Overvalue, no bueno. I don't care what name it is, because there's no more. It's after a while, people are gonna say, hey, this is not worth what I paid for it, and it's gonna plummet. That's what the market will correct itself.
Okay. Rihanna was talking about like Bitcoin, because she's seen platforms that trade in e-currencies.
That's based on faith. So it's so okay. So there is no, so there's a, so there, and I'm not knocking anybody who does, because I have a good client now, and I had to kind of walk him off. I said, look, this is based on faith. So money, it doesn't have, a piece of money doesn't have value in and of itself, but what's behind it is gold, right? And the backing of the government. A stock, you're going to put it in your account. It's a piece of paper. You won't get a paper, but it's in your account. The backing of that is the earnings of, there's something physical, right? There's a company behind it. Employees, even if it's all online, there's something behind it. Bitcoin doesn't have anything behind it but the hopes and desires of people. There's no gold. There's nothing behind it. So when people change their mind, and they usually do, you have to put something on value. If the government was backing it now, there's no backing it. Somebody say, hey, you know what? I gonna be smart. I'm gonna make a currency. And you're gonna pay me for it. So I would stay away from that. I don't make recommendations, but I can tell you what to stay away from.
There you go. What do you think about Forex trading?
There's a place for it. It's quite risky. And so I don't recommend it for people who are not trained as a professional to do it. Because it's a lot of buying and selling, and people are trying to make money off of the differences between currencies, and it's very tricky. You have to be maybe using a lot of money. Maybe governments do it, big companies do it, but I would stay away from it as well. It's not and people at my client, I have a client here, my beloved client, he does that too. And when I said, Warren Buffett said that there are so many people who are doing investing and they're not rich, it's because they don't want to get rich slowly. He said, that's powerful. Right?
So I know that the slides that you have are really property of Edward Jones. If there's any portion of it that you can share, can you forward to me whatever you can, and I will post it in the private group so that
I will talk to compliance.
Yeah, she has to find out first if anything can be shared, and if anything can, she will send it to me, and I will have it posted in the private group.
Yeah.
The link to the group is.
I can type out the content, or I can type out the content. I can tell you the list because this is public information, but the slides itself.
The slides are.
Yeah, but
if there's anything you can share, definitely, so that everyone can have. Janelle said, "What do you think about options?"
I studied options. So options is a hedging tool. So if a farmer wanted to lock in a price because they're afraid that pork belly the price is gonna go down, he might buy an option, a contract that will say this is a lock-in price. I'm buying a contract between you and I, and if the price falls, then you're gonna have to pay me at this price. And it's usually because options is legitimate for people in agriculture and people who are in business and want to lock in price.
Corn is a big thing that they use options for. Corn, huge
corn
for options.
And oil and stuff. Yeah. But as it relates to you and I who are just speculating on where the price of corn is gonna go, many people lose their shirts on that. Okay.
Wow, this is awesome. I feel like I'm not joking when I say this weekend I'm gonna get everything together from my Scotia account. You guys, let's talk. I'm going to start a watch list of certain stocks. I'm going to pick from those 5 groups.
Yeah.
And I am going to start getting ready for Monday morning, guys. Monday morning. I'm ready to fight
this. Yeah. Janelle, thank you. I can't see all the names, but thank you so much for Anna, Rihanna, everybody who was on. Thank you so much. And connect with me, LinkedIn, call me, and I guess you can see that I'm frank. I'll tell you, I'll walk you off the cliff. I'll tell you the truth for sure. If you don't like it, then at least you know.
At least you know.
Yeah.
So her contact information is here in the chat. I believe you can download the chat, guys. So if you click on, I thought there was an option to download the chat in one of, maybe I'm lying to you. I might be lying to you. Sorry. I can actually download the chat once this is done, and I will email it to everyone so that you have Danisha's information too, and you'll have the link to the Facebook group. I will go in and accept everyone because it's private. Because what I'm going to do is lock it down after this so that randoms don't come in, because we want to try to see how we can help each other. We're going to grow together out of this COVID. A part of what we do as Canadian small business women is to try to find ways to help all the entrepreneurs out there who are trying to survive during times like these. And what better way to do it than to try to diversify? So why not play around in some stocks? We're not going to play around anymore. It's not playing around anymore.
We don't play games.
We're not playing.
We're not playing.
We now know exactly what to do, and we can come up with a strategy in order to make things happen. Because I don't know about you, but once we're out of COVID, I'm trying to go on a lavish vacation, and
let's do that. Yeah. And that's your financial goal, right?
Yes.
Goal.
Any last words, anyone, before we leave? We did quite well.
Oh my goodness. Take care, guys.
Okay. Bye, everyone. And again, the link is there.
Connected with me already. Look at you. Thank you, Rihanna.
On top of things. So check. I'll send you. Actually, while we're on, I'll send you guys the link. Our next event is coming up in a month or two, something like that, and we have free early bird tickets. And I'm going to paste the link in the chat right now so that you all can go in and register. We'll have 5 breakout sessions, and we have one keynote. Our keynote is Lori Pelser. She comes out of Atlanta, and she runs Girl Go Be Great. She is an incredible speaker, and you will love her. You will love her. And we offer things like these workshops where you can really learn something to help you in your life. That's what we're about. So yeah, I think I can't say that's it for me for the day, because now I have to go answer emails, and then I have a 5 o'clock Instagram live. But thank you so much, Dwania. You have taught us a lot.
Take care.
Thank you. Thank you.
Thank you. Bye, guys. Is it over?
Bye, everyone.
Bye.
Dwania, stay on, but bye, everyone.
Bye, everyone.